Let's move on. Apollo Hospitals has reported a mixed set of Q1 numbers. Revenues and margins have come in line with street expectations. In the conference call, the management has said that lower discounts has impacted the top line in their 24/7 business. Suneeta Reddy, the managing director at Apollo Hospitals, is now with us on the show. Ms. Reddy, morning, and thank you very much for joining in. Let me get to your omni-channel arm, Apollo 24/7. On a quarter-on-quarter basis, I believe the losses have come down. Can you give us some guidance on reducing the cash burn? When will you, achieve operational break-even? And by how much have the discounts come down by?
So if you look at, the company has grown very well. Apollo Healthco has registered 1,805 crores of revenue, which is a growth of 22%. However, the losses were at 83 crores, which is down from last year when it was 89 crores. Going forward, yes, the company has reduced discounts. Discounts have come down from 18 to 15%, and this has resulted in a lower cash burn. Being an omni-channel play, the offline has done extremely well. They have grown by 22%, and this has really contributed to cash flows. Going forward, I think the company is well poised to reach EBITDA breakeven in Q4 and achieve 3,000 crores of GMV.
Hi, good morning.
Morning.
Could you tell us how much have online discounts reduced in the pharmacy space, and what's been the implication for growth there, revenues?
I think the best way to do this is to deconstruct the revenues. So offline and the EBITDA came in at 125 crores, which is really a growth of 13%. And there was a cash loss on online of 57 crores, which resulted in a negative 83 crores. So discounting, as like I said earlier, has come down from 18 to 15%. And there was also cost rationalization and focus on profitability that has yielded this quarter's set of numbers. But they are on track to achieve 3,000 crores of GMV.
I remember you had said that last quarter as well, that the omni-channel business will achieve operational break-even in Q4 of FY24, and you're sticking by it, Ms. Reddy. Just one more question on this subject, and then we'll move on to the other businesses, hospitals. You had fundraising plans. You were looking to raise money for the omni-channel play. Could you give us an update on that?
So currently, we are in a very healthy state with the offline generating enough cash for the business. However, like I said earlier, we have opportunities to raise capital, but this should not be at a discount to the actual value, and this should really maximize shareholder value. So we will look at this opportunity in September again, but currently the company is very well funded for growth and to achieve its targets.
All right. Hi, good morning, Ms. Reddy. Well, give us a couple of more numbers then. How do you see occupancy shape up from here on? And also your average revenue per hospital bed, if you could tell us, how is that number as well moving?
So we were at 62% occupancy. Going forward, we are on track to reach 68% by the end of the year. What is improving is our payer mix. So if you look at 82% of our payer mix now comes from insurance and cash. This has grown by a healthy 11%, and this has contributed to a volume growth of 6%. Currently, international patients are at 6% of total revenue, and this has grown by 34% over last year. So going forward, we are looking at a healthy occupancy of 68% with this payer mix. And this is what has contributed to our ARPOB is clearly the fact that our centers of excellence, our Congo specialties have contributed to 63% of our revenue, and therefore with the higher intensity of case mix and this payer mix, our ARPOB has gone to 57,704.
Ma'am, could you talk to us a little bit about margins, because they're blended margins overall. So cost pressures seem to have emerged across segments. I mean, hospitals, Apollo Health and Lifestyle. Could you guide us on what blended margins could look like going ahead, FY24?
So I think, the healthcare services business has registered good margins, and there is a scope to improve these margins by 100 basis points. Currently, we're at 23.6, and we're looking at, ending the year with close to 25. Apollo Health and Lifestyle has added a diagnostic network, which has contributed to cost, and therefore, but they are registering revenues of 100 crores per quarter, and in line with our projections for 500 crores for the year. This is the network addition cost, plus we had some one-time cost this year of Apollo Health and Lifestyle had a one-time cost of 15 crores, which is why it looked like the costs have increased. In the healthcare space, yes, we did have additional costs. Bringing on doctors at guarantee money and employee cost has increased, but we do believe that, by the end of the year, costs will come down.
And for the diagnostic business, you're saying your guidance is for 500 crores of revenues for this year versus about 100 that you've done in the current quarter. Can you just getting back? Yes. Can you just getting back to the hospitals business? You told us the occupancy target, I think 68%. The average revenue per occupied bed, as you pointed out, is 57,500 plus or minus. It's gone up by 11% on a year-on-year basis. What led to that? And what is the guidance on the average revenue per bed? I remember in some interaction before you had even spoken about 60,000.
Yes, clearly there is an opportunity to grow to 60,000. I think I answered that earlier when I said that our payer mix had changed with insurance and cash coming in at over 82% and international patients at 6%. And therefore, this has resulted in a higher ARPOB. This in line with surgical volumes going up by 60, currently at 63% of total revenue, has contributed to this ARPOB of 57,700 rupees. Going forward, I think, with this focus, we should be able to continuously, next year, probably grow the ARPOB by another 6%. But volume growth is where our focus is.
All right, Ms. Reddy, thanks so much for stopping by and filling us in with all those details. Wishing you all the best for the remainder of this fiscal, and we're looking forward to chatting up with you rather soon.